Hello, this is Robert Romano, Vice President of Public Policy with Americans for Limited Government. And today we're going to be talking about my latest piece, Why China Left Trump with little choice but to slap on the 25% tariffs on $200 billion of Chinese goods. President Trump ran on this. He said he would do it, and he did. President Trump is levying 25% tariffs on $200 billion of Chinese goods. That used to be 10%, and that also comes atop 25% tariffs on $50 billion of high-tech goods from China as well. The markets are not in free fall, but there's a little bit of panic going on right now. As you can see here on the S&P 500 index, there's definitely a little bit of a correction going on here. That's not surprising in the great scheme of things. We were testing our previous highs of about 2,900, and then since the trade talks broke down last week, we've seen a little bit of a decline. But that's not why we make policy decisions, is it? We make policy decisions based upon what's good for the U.S. economy, what's good for the American people. And on those counts, I think that we're doing really well. Even with Trump's trade policies, we've been seeing record low unemployment, 49 years. I mean, it's been 49 years. You have to go back to 1970, where the unemployment rate was as low as 3.6%, which is what you see it today. And the U.S. economy is accelerating since President Trump took office. As you can see here, we grew at 2.9% in 2018, and we had one of the best first quarters in several years at 3.2%. This is a good thing for the American people, and you can attribute it to President Trump's trade policies, but also his tax cuts and deregulation that aim to make the U.S. more competitive globally. And so let's take a look at what's going on today. President Trump has made good on his threat after trade talks broke down last week. What happened on May 3rd is China tried to renege on the deal it was making. We were going to have provisions in a U.S.-China trade deal on currency manipulation, financial services, competition policy, forced technology transfers, intellectual property, and trade secrets. And China just crumbled all that up and said, we're starting over. Here's a bunch of revisions. We were in the final stages of this. And so they threw the deal in the garbage. President Trump had responded on May 5th saying we were going to do a 25% tariff on the $200 billion of Chinese goods. He's made good on that threat. And here we are today. The tariffs have gone into effect. China is now promising to retaliate, but it remains to be seen how much leverage they really have in this situation. The U.S. economy, again, is strong. Unemployment is very low. Growth is doing well, and inflation is low. It's really hard to pinch us right now. 2% inflation the past 12 months. There was a lot of doomsaying about the tariffs when they went into effect last year, and we're supposed to be seeing all this inflation, and frankly, we're not seeing it. It's 2%. That's kind of what it usually is. That's considered a normal inflation rate by the central bank, the Federal Reserve. So let's take a look at what's going on here. Why did this happen? Well, China was promising that we were going to have a deal. They were making concessions on a number of issues, including currency and intellectual property, and they threw that in the garbage. And so we had to make good on our threat. It's the art of the deal. You have to use your leverage. And so we've been. I think President Trump has been negotiating in good faith. The tariffs were supposed to go into effect, the 25%, in January, and Trump gave them a 5-month reprieve in lieu to allow the negotiations to continue. And then suddenly China wants to crumble up the deal. Well, then President Trump's going to go ahead and do the tariffs, which, by the way, are probably really necessary. When you look at, this is from my piece here, since China entered the World Trade Organization in 2001, U.S. manufacturing market share has dropped from 13.4% to just 7.5% in 2017. That's according to the World Bank. That's not good. At the same time, China has risen from 5%, 0.3% to 16.6% in 2017. Although, to be fair, it peaked in 2015 at 18%, 18.8%. So you can see down here, as China has devalued its currency, it was able to increase its market share in the early 2000s. And then as its market share was increasing, it was able to revalue it slightly so they could charge more and still make a lot of money because they were still expanding their market share. And as you can see, China has, it's been an economic miracle for them. They've increased dramatically their market share. They're now an industrial powerhouse. In the meantime, the United States, during the same period, we used to be increasing our manufacturing market share all the way through until the dot-com bubble. And then after China entered the WTO, our market share has been precipitously declining, as has labor participation amongst working age adults, 16 to 64-year-olds. This is data from the Bureau of Labor Statistics. And as you can see, that our market share globally, manufacturing, has a direct impact upon the amount of people who are participating in the U.S. economy. And for China, their currency devaluation it enabled them to make cheaper goods to their exports to the United States and increase their market share. And then as they got a bigger and bigger global monopoly on manufacturing, they're able to jack up prices. Look at that. And so you can see the comparison there, where our market share is declining, their market share has been increasing. And so this is what President Trump ran on. This is why he won in the Rust Belt states of Michigan, Pennsylvania, Ohio. And this is what he said he was going to do. He said we have to protect our economy, and that's what we're doing now. 25% tariffs on $250 billion now of Chinese goods, including the high-tech stuff. And there's no question. I mean, there's some dispute about whether currency manipulation has had an impact, but don't take my word for it. Art Laffer and Paul Krugman agree on hardly anything, but currency manipulation has absolutely boosted Chinese exports. And it's not just Laffer and Krugman that are saying this. If you look at the International Monetary Fund in 2015, the World Economic Outlook did a study of 60 economies, including China. And it found that, quote, a depreciation in an economy's currency is typically associated with lower export prices paid by foreigners and higher domestic import prices. And these prices change in turn lead to a rise in exports and a decline in imports. Reflecting these channels, a 10% real effective exchange rate depreciation implies, on average, a 1.5% of GDP increase in real net exports. That's amazing. Art Laffer, the way he puts it in 2015 op-ed at Forbes, quote, currency manipulation is a potent tool of mercantilists, tempting nations to increase their trade balances and export domestic unemployment to the countries that are not devaluing. A beggar thy neighbor approach to international economics. Laffer cited the Peterson Institute for International Economic Study of 20 nations that found, quote, the currencies of the interveners that are substantially undervalued boost their international competitiveness and trade surpluses. And that cost anywhere from 1 to 5 million jobs in the United States and contributes 200 billion to 500 billion of our annual trade deficits. As for Paul Krugman, although recently he didn't think that the yuan was much undervalued anymore, the impact in the 2000s was very clear. In 2010, he wrote, quote, this is the most distortionary exchange rate policy any major nation has ever followed. And it's a policy that seriously damages the rest of the world. Most of the world's large economies are stuck in a liquidity trap, deeply depressed. This was right after the financial crisis, by the way, but unable to generate a recovery by cutting interest rates because the relevant rates are already near zero. China, by engineering an unwarranted trade surplus, is in effect imposing an anti-stimulus on these economies, which they cannot offset. And it worked for China. Their economy has been growing. Their market share has been increasing. Again, I mean, you look at that chart, the currency depreciation. I mean, look at that. The depreciation actually began in the mid 90s, and then after they got into the WTO, their market share, again, it's been an economic miracle. It's been good for the Chinese, but not so good for us. The economy hasn't grown above 4% since 2000, not above 3% since 2005. We hit 2.9% last year on an annual basis, and we're accelerating right now. We're at 3.2%. And I don't think it's a coincidence that President Trump has started to implement his trade policies that he ran on. And we have to do what we have to do. I mean, China has been, since 2014, China has very much depreciated its currency. What used to be worth $6, 6 yuan per dollar, now it's at 6.8 today, as you can see here. So the way this works, you're looking at an xe.com chart of the US dollar to the Chinese yuan. And so when the exchange rate is lower, 6 yuan per dollar, that's a more valuable currency for the Chinese. And when it's higher, 6.8, as you can see today, that means that it's less valuable. And so China has, after the financial crisis, it was able to revalue its currency, jack up the prices. And then when it looked like they might start to lose some market share, then it started devaluing again. You see a gap here between recently from 2017 to 2018. And again, they're back to devaluing their currency. And they're probably because their market share peaked in 2015 there. So I think that they're a little concerned that maybe they want a little too full throttle and jacking up the prices. Now, President Trump is making sure that, well, they're not going to regain that market share. We're going to have 25% tariffs on $250 billion worth of Chinese goods. And that's just the way it's going to be from now on. Again, this is not hurting us. The economy is accelerating. Unemployment is really low. Really, really low. 3.6% in April 2019, the lowest since 1970. And inflation is basically nowhere to be found, 2%. That's not bad. And so who's panicking? Wall Street. Wall Street is panicking, and that's not your problem. That's not the American people's problem. And President Trump has said that this was going to happen. No one should be surprised that President Trump is following through on his promises. And you know, it's almost a final note here. The talks with China are continuing. This is from President Trump just a few hours ago. The talks with China continue in a very congenial manner. There's absolutely no need to rush, as tariffs are now being paid. So they're going to continue talking. And as well they should, but we need to do what's good for the American people. We need to do what's good for the U.S. economy, what's going to create jobs here in the United States. Our manufacturing has been decimated. I mean, look at this. Since China entered the WTO, you went from more than 17 million manufacturing jobs to less than 12 million after the financial crisis. You saw some, little bounce back there. And then in recent years, since President Trump took office, that number's been accelerating. You have about 470,000 new manufacturing jobs that have been created since President Trump took office. And that's what he said he was going to do. This is a president who keeps his promises, and he's going to do what's necessary. Not only does he get credit for trying, these are really tough issues. The easy thing would be what Clinton and Bush and Obama did, which was nothing except allow China to ratchet up their global manufacturing market share, let the currency depreciation price us out of a good market, let the labor participation rate decline. These weren't good things for the U.S. people, for the American people, and for the U.S. economy. We've been losing, and that's what President Trump ran on. That's why he got elected, and that's why, frankly, he's in a very strong position right now to negotiate with the Chinese. I think that whether we get a deal or not, that clearly, the tariffs are necessary. Look at their global manufacturing market share. We've been getting blown out of the water. Ours has been declining. And so, if anything, the only question here is not whether the tariffs are justified, for clearly they are. And again, don't ask me. Don't take my word for it. Economists agree. The Peterson Institute agrees. The IMF agrees that the currency depreciation boosts exports. And so we need to do what's necessary to protect the American people and to protect jobs here in the United States. And it's not a question of whether the tariffs are justified. It's really just a question of, are they big enough? That's the commentary. This is Robert Romano, Vice President of Public Policy with Americans for Limited Government. Have a good day.